Hi student. Now we recall about chapter 2. We study about subjects and objectives of accounting. Particularly, we understand what are assets, what are liabilities and owner's equity, especially owner's equity of a corporation. And one of the most important sections in chapter 2 is basic accounting equation. Assets must equal the sum of liabilities and owner's equity. The problem is that when financial transactions occur, they will affect to the components of the accounting equation. Financial transactions can make assets, liabilities, or owner's equity increase or decrease. The duty of accountants is to record these changes. We have some examples below to determine the chain of assets, liabilities, and owner's equity when business transactions occur. Here, the following examples are business transactions for computer programming business during its first month of operations. We have 4 transactions. The first, investment by owner. Second, purchase of equipment for cash. The third, purchase of raw material on credit. And the last transaction, services provided for cash. How does this transaction affect to the accounting equation? To answer for this question, first, analyze the transaction affects to which subjects in the accounting equation. The second, identify the increase or decrease of each subject. The first transaction, investment by owner. Peter Jackson decides to open a computer programming service which he names Shopify. It means Shopify is the name of the company. On the 1st of September 2015, Peter Jackson, the owner of this company, invested $15,000 cash in the business. Now, this transaction affects to which subject to accounting equation? You see, the owner invested cash. Of course, cash is affected by this transaction. And when the owner invests cash, cash increase or decrease? Cash increase. Of course, cash increased by $15,000. And another subject is affected by this transaction is owner's capital. Here, Peter Jackson invested in the business. It means owner's capital increase. So, this transaction results in an equal increase in cash and owner's capital. Cash increased $15,000. Owner's capital also increased $15,000. So asset increased and owner's equity increased. Observe that the equality of accounting equation has been maintained. Note that investment by owner don't represent revenue. It's an initial investment which makes owner's equity increase. And we move to the second transaction. Purchase of equipment for cash. Shopify purchased computer equipment for $7,000 cash. Now, how does this transaction affect to components of accounting equation? This company purchased computer. It means computer equipment or assets increase. And this company paid cash for seller, so cash decreased. Yes, the answer is cash decreased $7,000. Equipment increased $7,000. So the total assets are remain still $15,000. One asset decreased. Another asset increase with the same total. This transaction results in unequal increase and decrease in total assets, though the composition of assets changes. The third transaction, purchase of raw material on credit. This company purchased raw material for $1,600 from Ant Supply Company. The purchase was made on account. Ant agreed to allow Shopify to pay the bill in October. This transaction is a purchase on account or a credit purchase. Shopify purchased raw material. You remember raw material is classified as inventory in current assets. So when company purchase raw material, inventory or assets increase. And because the purchase were made on account, so accounts payable, it means liabilities also increase. And this transaction affect to inventory and accounts payable. In particular, inventory increased $1,600, while accounts payable also increased $1,600. So total assets and total liabilities increase, and the equality of the accounting equation has been maintained. The last transaction, services provided for cash. This company received $1,200 cash from customers for programming services it provided. This company received cash. Receive cash, it means cash increase or assets increase. And revenue increase. Yes, this company provides services for customers, so revenue from the sale from earning process increase. And you remember, revenue is one of the factors that make owner's equity increase. Revenue increase, it means owner's equity increase. So this transaction make assets and owner's equity increase. Summary: each transaction must have a dual effect on the accounting equation. If an asset increases, there must be a corresponding 1. Decrease in another asset, or increase in a specific liability, or increase in owner's equity. All of these to keep the accounting equation in balance. We study Chapter 3, Financial Statements. It's important to indicate that financial statements are final products of accounting, of financial accounting. Businesses use 4 basic financial statements to communicate financial information to decision makers. They are balance sheet, income statement, cash flow statement, and notes to financial statements. Besides, another statement is owner's equity statement. Balance sheet. The purpose of a balance sheet is to show the financial position of a business on a specific date, not for a period of time, usually the end of the month or the end of the year. Moreover, the balance sheet focuses on assets, liabilities, and equity of a company. I hope it's brief enough for you to remember. This is the balance sheet of a business. As you can see, balance sheets have two sides, the asset side and the liability, the equity section. The asset side of the balance sheet may be divided into 5 separate sections: current assets, long-term investments, property, plants and equipment, intangible assets, and other assets. Current assets include cash and those assets that will be converted into cash or consumer in a relatively short period of time, within 1 year or the operating cycle. Now, we explain about operating cycle. The operating cycle for a particular company is the period of time it takes to convert cash back into cash. And the operating cycle of a merchandising company is longer than that of service firm. Long-term investments include stock investment and investments in other entities. Property, plant, and equipment includes the land, buildings, and equipment proactively in use by the company. Intangible assets are assets that lack physical existence and include items like perpetuation, copyrights, or goodwill. Other assets in the section is to report asset accounts that just don't seem to fit elsewhere, such as a special long-term receivable. Next, the liability section is divided into current liabilities and long-term liabilities. Current liabilities are debts that are due to be paid within 1 year or the operating cycle, whichever is longer. For example, accounts payable, salaries payable, interest payable, taxes payable, and so forth. Long-term liabilities relate to any obligation that is not current and includes notes payable, mortgage obligation. You remember we study current liabilities and long-term liabilities in Chapter 2, Subjects of Accounting. And do you remember the three forms of business organization: sole proprietorships, partnerships, and corporations? The illustrations in this book generally assume that business is incorporated. Therefore, the owners of the business called stockholders, and the equity section consists of capital stock and retained earnings. Capital stock includes amounts received from investors for the stock of the company. The investor becomes the owners. Their shares can be transferred to others. Retained earnings is the profits that has been retained and reinvested into expansion of the business. Now, if you have lecture note, we can open the page 18. You can see the balances of Class C company and check again to remember all of categories you have just studied, and check the accounting equation. Do total assets equal total liabilities and equity? Okay, I think you don't have lecture note. So this is the balance sheet of Class C company, and you can check again all the categories that you have just studied. Especially check accounting equation. Total assets. Do total assets equal total liabilities and equity? You have 5 minutes to check again. From the balance sheet, we can calculate some ratios that show financial ability of a company. There are working capital, current ratio, and quick ratio. Working capital is the difference between current assets and current liabilities. The current ratio is calculated by dividing current assets by current liabilities, and quick ratio is calculated by dividing only from quick assets include cash, short-term investments, and accounts payable by current liabilities. You need to remember this ratio. We have a small example for this section. As of the 31st of January 2018, Tiger Company has assets of $30,000, includes current assets of $10,000 and other assets of $20,000 and current liabilities of $5,000. What are the working capital and the current ratio for Tiger Company as of the 31st of January 2018? The answer is working capital is calculated by current assets minus current liabilities. It means $10,000 minus $5,000 and working capital is $5,000. Current ratio is calculated by dividing current assets by current liabilities. It means $10,000 divided by $5,000 and the answer is 2 times. Very easy. The second financial statement is income statement. The income statement reports revenues, expenses, and net income or net loss of a company for a period of time. Remember, the differences between the revenues and expenses is identified as the net income or net loss, and income statements reflect results of operations of the company. This is the income statement form of a corporation. The income statement lists revenues first, followed by expenses. Finally, the statement shows net income or net loss. Net income results when revenues exceed expenses, and net loss occurs when expenses exceed revenues. Note that net income on the income statement is added to the beginning balance of owner's capital in the owner's equity statement. This is the form of owner's equity statement of a corporation for the months ended at 31st of November. On the 1st of November, owner's capital assumed that is zero, and investor invests $15,000 in the business and plus net income $3,000. Investor also withdraw $4,000 during the month. So at the end of the month, the owner's capital is $14,000. The third financial statement is cash flow statement. This statement answers the following question. Where did cash come from? What was cash used for? And what was the change in the cash balance? It means that cash flow statement provides information on cash receipts and payments for a specific period of time. And this statement reports the sources, uses, and net increase or decrease in cash. The last financial statement is the note. Financial statements by themselves may not tell the whole story. Many important details about company cannot be described in money on the balance sheet or in income statement. So, notes to financial statements are used to describe accounting policies, major business events, pending lawsuits, and other phases of operation. The notes will be more voluminous than the financial statements themselves. I think that's all for chapter 3, and for the part 2 of chapter 2. After this lesson, I have some multiple choice questions for you. Thank you for your attention.